most of Far East customers and friends are equity oriented, so I wanted to start with a brief description of what the bond futures and the Treasury note futures were. So if you look at the screen, you see the basic contract description from Bloomberg on the two different contracts. Futures contracts on U.S. government treasuries of different maturities. When we speak of the maturities, the bond is a 30-year debt instrument auctioned by the U.S. government to fund all the wonderful things that the U.S. government does. The 10-year, or the TYZ contract, is the same instrument with a shorter maturity, obviously. There are some minor differences with the two contracts, and we're going to be sort of interchanging between the two. If you take a look at those descriptions, you can see that the tick values are a little bit different. 10 years trade in half ticks, $15.62.5 per tick, per half tick. And when we speak of a tick, obviously it's a half a tick in the 10-year. The bonds trade in full ticks. Each tick is worth $31.25. They trade electronically mostly in the futures pits now. The reason that we're still down on the trading floor is because the options that are based off of these contracts mostly still trade in the pits on the floor. And, oh, okay. All right. There you go. That'll be a little easier to read. The options contracts that are based on these futures contracts have the same underlying details, basically. They're a lot more liquid in terms of getting things done in the pit than they are on the screen. You can trade the option contracts on the screen also. It's just if you try to do anything more complex than, say, buying an outright call or a put, or doing a simple vertical call spread or vertical put spread, you can do those on the screen, and they're fairly liquid. But by and large, any type of complex or more complex option strategy pretty much has to be done in the pit, and that's why I'm still down there hanging out with all the old pit traders in the CBOT, CME group trading floor. All right, let's move on. I wanted to show you a couple things besides the contract specs here. Let me move these charts around. These are two different bond charts. We've placed them right next to each other. They're minor differences, but it's sort of an important difference that we need to be aware of. The top chart is the December 11 futures contract. The bottom chart is a rolling front month contract that, well, let me go back to rolling. The futures contracts, we have a quarterly cycle. They go December 11, March 12, June 12, and Sep 12. That's the 1 year out. They're really only liquid in the front contract, but there's a tendency as we get close to expiration for price differences to become magnified. So what the charting services all try to do is, as the liquidity moves from, let's say we're in the D's contract right now, but about a month ago we shifted it from the Sep contract. But as the contract matures and gets closer to expiration, the volume starts to move to the upcoming front contract. Right now the front contract is the DC 11, so that's why I put that up at the top. The rolling contract has some price quirks though because of the rollover effect, and there seems to be price gaps a lot of times. If you're looking at, say, a shorter term chart, as you get close to expiration, you'll see all of a sudden on the rollover date this massive move on the contract, and that's caused by the rollover because there's a maturity difference between the expiring Sep contract, which just went off, and the new maturing, or the new coming up D's contract. So it causes some quirks. I think it also messes up a lot of the technicals with looking at daily charts, especially looking at the rollover contract. It's in different charting services, like on TradeStation here, they have the symbol @US. On some other contracts, they'll have a different designation. On Bloomberg, it's TYA. That'll be the front contract. On eSignal, it's US pound symbol F for the front contract. I'm always going to try and look at the current contract, the DC 11 contract, And I try not to look too much at the daily charts in terms of the technicals that I utilize, because the rollover effect muddies the waters a lot. If you're trying to trade these futures technically, which is the way I do it and the way I've found some success. So I'm going to move to an hourly contract, and I'm going to try and just stick with the D's contract here and sort of ignore this front month rollover contract because the technicals get blurred. So we're going to go and take a look at this chart here, and we can see on this D's chart on the top, if we're going to focus on that, this is the recent history back to the sort of beginning of October is an hourly chart that we're looking at right now. And you can see how it's been in a fairly narrow range. The bond contract is traded here between 138, 137 and some change down here up to 141. That's a fairly narrow range for the bond, which is a very volatile creature. In the time span that we're looking at here, it's only been, what, about 10 days there. So we're going to look at that, but we also want to look at other charts too. And I'm going to pull up another one over here. And this is really my focus now. This is the hourly 10-year chart. And this is from one of my e-signal systems. And this is my bread and butter. The 10-year contract has average daily volume of about 1 million contracts now, whereas the bond contract trades quite a bit less. I think the average volume is around 300,000. I've sort of grown up with the 10-year. A lot of my customers were mortgage traders, and the mortgage traders utilize the 10-year because it has the same maturity structure as their mortgages, so they use the 10-year to hedge a lot. It has a lot more open interest. It has a lot more intraday volume, and I find that looking at the hourlies, the technicals work a heck of a lot better on the 10-year than even on the bond sometimes.
You look at the overnight chart at all?
This is a 24-hour chart. This includes all the overnight sessions. They've become more and more important as the electronic systems have taken over from the pits. It's structural changes that have occurred. It's very important to watch 24-hour charts. A lot of people still try to watch day session only charts, but they miss a lot of moves. Important levels. In these too, we'll see important highs and lows made overnight. Yeah, we're being driven by the same news as the correlation between the 10-years and the bonds and the equities have become so perfectly, bonds go up when stocks go down, and stocks go up, bonds go down, and it's become very, very much one-for-one correlation. It never used to be. There's been periods where they've been perfectly correlated before, but not in this point right now. This 10-year chart here, again, it's an hourly chart, goes back